Thank you very much for including this paper in this session and for showing up. So Andrew just gave a very nice talk about credit markets with a particular focus on consumer loans. I'm going to also talk about credit markets, but my focus is going to be on business loans. So this is joint work with my colleague Charles Karomiris and with two other co-authors. So let me start with some very broad motivation. So one of the main obstacles that firms in emerging markets face is lack of access to credit. So when you take a corporate finance class and you study optimal capital structure, the implicit assumption we are making is that firms can borrow as much as they can. That's a relatively good assumption for large firms in a country such as the US, but it's not such a good assumption for smaller firms in, let's say, less developed countries. So in less developed countries, banks have very little information about relatively small borrowers, information about their cash flows, about their profitability. So most of the times they require the borrower to pledge some type of collateral before granting a loan. So just like when you want to buy a house and you're going to go to the bank and ask for a loan, the bank is going to take that house as collateral. The same happens with a business loan. Some company has an investment opportunity. It's going to go to the bank in order to ask for a loan. The bank usually is going to require the company to pledge some type of collateral. So just to give you the importance about the extent of collateral in emerging markets, I'm going to show you a figure that's based on a survey conducted by the World Bank. So let's consider firms operating, say, in Eastern Europe. So what this graph is telling us is that of all the firms that are applying for credit, 81% of them are required to pledge collateral in order to get a loan. So this is a very large number. If we look at companies in other regions of the world, let's say South Asia, it's the same thing. So per every 10 firms that are applying for credit, 8 of them are required to pledge collateral and 2 are not required. So again, this is a very big number. If we compare it to the US, the numbers are much lower. In the US, around 40% of the firms that are applying for credit are required to pledge collateral in order to obtain such credit. So why is collateral so important? Well, basically, if for some reason a company defaults on its loan, the bank has the right in order to recover the collateral that's being pledged. So basically, the use of collateral protects the bank somewhat from default risk. And as I said at the beginning, one of the main obstacles that firms face in emerging markets is lack of access to credit. Well, a key factor that restricts access to credit in emerging markets, it's precisely lack of sufficient collateral. And this is illustrated nicely in this other survey done by the World Bank. So let's focus on one particular region of the world, South Asia. So what is this figure telling us? Of all the companies in South Asia that applied for a loan to a bank and were rejected, 72% of them, roughly 3/4 of them, were rejected precisely because lack of sufficient collateral. Now, there's even some firms that are discouraged from applying to credit in the first place. So the other thing that's happening is from all the firms that do not even apply for credit, 31%, or roughly 1/3 of them, do not do it because they think that the collateral requirements are too high. So what this is telling us is that insufficient collateral is a key factor that restricts access to credit in emerging markets, and lack of access to credit is one of the main obstacles that firms face in emerging markets. So what exactly are we thinking about when we talk about collateral? Well, it's actually useful to distinguish two types of assets. Immovable assets on the one hand, think about real estate, and movable assets on the other hand, assets that can move, think about machinery, equipment, inventory. What's interesting is that banks in emerging markets usually only lend against real estate assets. They rarely lend against other assets such as inventory or equipment. A bank in the US, on the other hand, accepts any type of asset as collateral. It accepts inventory as collateral. It even accepts accounts receivable as collateral. So this is another report of the World Bank about Chile, which is my home country. Anybody else here from Chile? Hola. So, according to this report, the financial sector in Chile is pretty good, especially relative to the Latin American region. But one of the main shortcomings is that financial institutions over-rely on real estate as collateral. So banks basically in Chile are not accepting other types of collateral than real estate as collateral. And this has a lot of consequences. So first of all, the loans that are backed by real estate or immovable collateral are larger in size. Secondly, not only are they larger in size, but the maturity is longer in terms of years. And not only is the maturity longer, but actually the interest rate is lower. So the terms of the contract for loans that are backed by immovable collateral are just better than the terms of the contract for the loans backed by movable collateral. So what do we do in this project? In this project, we think that the reason why banks in emerging markets are so reluctant to lend against other types of collateral than real estate has to do with collateral loss. So, as I said before, the law makes a clear distinction between two types of assets, immovable assets and movable assets. And each country has specific laws regarding immovable collateral and movable collateral. So let's say for the US, the laws regarding movable collateral is the Article 9 of the Uniform Commercial Code. Regarding immovable collateral, well, different states actually have different real estate or real property laws. So in this paper, we're going to push the idea that the main problem in emerging markets is that they have weak laws regarding movable assets. The laws regarding immovable assets are okay. The main problem is the laws regarding movable assets, which makes it very hard for banks to accept movable assets as collateral. So in this paper, we're going to show that this has two consequences. First of all, in countries that have weak laws regarding movable collateral, banks lend less against movable assets. And secondly, and this is very important, because of this, firms end up investing less in activities that are intensive in movable assets. They have to finance those activities in order to do them, but they can't because they cannot use movable assets as collateral. So that's going to be a big problem. So let me give you a couple of examples of what exactly do I mean by weak versus low collateral law. So for example, in some countries, the law requires an exact description of the asset being pledged as collateral. If you're pledging a ship, a car, a machine, there's no problem. All of those assets have a serial number. But what about inventory? It doesn't. By definition, inventory is turning around, rotating all the time. So when the law requires an exact description of collateral, basically the banks will not be able to accept inventory as collateral. Let me give you another example. Some countries do not have a collateral registry. What does this mean? Imagine that Andrew wants to start a business of textile manufacturing. He goes to me, I'm the loan officer of the bank. He asks for a loan and he says, look, I have this machine in order to pledge. Now let's assume, and this is only hypothetical, that Andrew is not the most honest man in the world and he has already pledged that same machine to another bank. It's very difficult for me as the loan officer of my bank to know whether that asset has been pledged before or not. In the US, there's a collateral registry. So if this transaction takes place in the US, Andrew comes with the machine, all I have to do is log in to this electronic collateral registry and I can see immediately whether that asset has been pledged before or not. With a lack of collateral registry, I may be reluctant to lend against that asset. A third example has to do with enforcement. So in the event of default, some countries give only one option for the creditor to repossess the collateral, which is sue the company and go to court. And you can imagine that in some emerging markets, this is going to be very painful. Courts are congested, they're inefficient, there's a huge backlog per judge, so this process can take a lot of time, years. And during that time, the asset can depreciate very, very badly. So the Doing Business project from the World Bank has actually ranked different countries in the world according to their strength of movable collateral loss. So in this paper, we're going to focus on particularly 12 countries, some of them from Latin America, some of them from Eastern Europe, some of them from Europe, from Asia. And the World Bank gives an index that measures the strength of the movable collateral loss in each of these countries. The index ranges from 1 to 7, 1 being weakest, 7 being strongest. So here we have Chile with a very low movable law index, indicating that in Chile it's very hard to pledge movable assets as collateral. On the other hand, we have a country like Malaysia that ranks very high in this index, and which its banks in Malaysia can easily use movable assets as collateral. So in order to conduct the analysis, we got access to a proprietary data set of one multinational bank that's lending across different countries, these 12 different countries. It's a secured lending program. So that, by the way, that's another difference with what Andrew was saying. The analysis of Andrew was all unsecured loans. They were not collateralized by any type of assets. This data set includes only secured loans, and it's mainly for small and medium enterprises. I cannot give you the name of the global bank for confidentiality reasons, but we have a lot of information. We have for each loan how much money did the bank lend. We know whether the asset being pledged is immovable or movable, and what's kind of cool is that we have a measure of the liquidation value. So how does this work? When a company defaults on the loan and the bank recovers or takes back the collateral that was being pledged, the bank is not going to keep that collateral. That's not the business of the bank. The bank has to sell that collateral, and it usually sells it in some type of auction. So what we have here is information about how much money the bank would get if it sold the asset in the auctions. And this allows us to calculate the loan to value for each loan, which is the ratio between the loan amount and this liquidation value. So in words, it's the amount of cents that the bank is lending against $1 worth of collateral. So imagine Micaela wants to purchase a house. She's doing well, $1 million. She only has $200,000 though, so she's going to ask for a loan of $800,000. And the bank is going to give her that loan. So in that transaction, the loan to value would be 80%. The bank is lending 80 cents per $1 worth of real estate collateral. So we find a couple of very interesting things. So here we plot the frequency of immovable collateral for each country against this movable collateral law index, and we find a negative relationship. What does this mean? Consider Chile. It's a country with relatively weak collateral loss. Of all the loans that this global bank grants in Chile, more than 90% of them are backed by real estate and less than 10% by other type of movable assets. So this is completely consistent with this World Bank report we were discussing some time ago. On the other hand, let's consider Malaysia, which has strong collateral loss. The frequency is much more evenly spaced. Around 60% of all the loans that this global bank gives in Malaysia are backed by real estate, and the remaining 40% by movable assets. The next thing we do is try to see what's the effect of collateral loss on loan to value. So what we do here is for each of the 12 countries, we calculate the loan to value of immovable collateral and movable collateral. So how do we read this number? This, for example, 0.78. It means that in Chile, the global bank is on average lending 78 cents per $1 worth of real estate collateral. And what do we find here? A couple of cool things. If we look at Malaysia, that has strong collateral loss, the loan to value for real estate is 0.84. The loan to value for movable assets, it's lower, 0.74, but not that much lower. If we consider Turkey, which is a country that has weak collateral loss, the loan to value backed by real estate is not that low. It's relatively similar to the one that we observed in Malaysia. The real problem is the loan to value for movable collateral. It's super low. It's 0.47, which is much lower than the 0.74 that we observed in Malaysia. Let me put this graphically. Here I plot the difference between the loan to value of immovable and movable assets for each country against the index of movable collateral law, and we see a strong negative relationship. What does this mean? We were talking about Turkey just a minute ago. It has weak collateral loss, and the loan to value of immovable collateral is much higher than the loan to value of movable collateral. On the other hand, if we look at Malaysia, that has strong collateral loss, the loan-to-values of these two types of assets are much more similar? Well, we have shown that movable collateral laws affect the way banks lend in emerging markets. But how does this affect the way firms invest? Well, in order to tackle this question, what we're going to do is take advantage of the fact that some sectors in the economy, some industries in the economy, are more intensive in real estate than others. And in order to measure real estate intensity, we're going to calculate the ratio of the value, the average ratio of the value of land and buildings to total assets. So we have ranked 25 manufacturing sectors according to their intensity in real estate. And let me give you an example of a sector that's intensive in real estate: wood. So companies that manufacture wood, they have to use sawmills, etc. They have a lot of real estate in order to pledge, not too much machinery. On the other hand, if we consider a company manufacturing electrical machinery, they have a lot of equipment in their production process, but not too much real estate in order to pledge. So what we do is the following. For each country, we calculate the fraction of overall manufacturing output that's being used in sectors that are intensive in real estate. Think about manufacturing of wood. And we plot that against the movable collateral law index, and we see a strong negative relationship. What does this mean? Consider Chile, weak collateral laws. Of all the manufacturing output in Chile, almost 90% of it is being used in sectors that are intensive in immovable assets, and only 10% in the remaining sectors. If we consider a country like Malaysia that has strong collateralized, the sectoral distribution is much more even. Around 50% of production is being allocated towards sectors such as manufacturing of wood, and the remaining 50% to the other sectors in the economy. So let me conclude. So I hope that I have convinced you that collateral plays a very important role in bank lending in emerging markets. I also hope to convince you that there's a regularity, that banks in emerging markets usually only lend against real estate assets. They rarely lend against other types of assets. So in this paper, what we do is we propose an explanation for this regularity. What we say is that banks might be reluctant to accept movable asset as collateral because they have weak laws regarding movable collateral. And we say that this has two important consequences. First of all, that countries that have weak collateral laws, we observe that banks lend less against movable assets, so these movable assets lose part of the debt capacity. And secondly, this actually distorts the way firms invest. So this is a violation of the Modigliani-Miller theorem that we study in corporate finance. The fact that firms cannot pledge movable assets in activities that are very intensive in movable assets means that firms are going to invest less in those activities to begin with. Thank you very much.